Welcome to Finance Unplugged, a show that brings you unfiltered insights in the world of finance, proudly founded under the Wits Investment Society. Now, on today's episode, our focus is on the intricate landscape of the real estate sector, with a focus on Accelerate Property Fund. Now, I've invited an expert who is going to dissect the latest developments, challenges, and the triumphs of Accelerate Property Fund right here on Finance Unplugged. Make sure to tune in.
Vandu, thanks. My name is Simon. I am in the media a whole bunch. I've been in markets for literally decades, 30 plus years. Started as a school kid way back in the day. I am doing a show on BusinessDay TV. I write for Financial Mail. I do a podcast for Moneyweb every morning at 6:30. And then I also run the Just One Lap education platform.
Okay. I thought I should also introduce myself. So I'm Tabang. I'm the head of corporate finance and portfolio under the Wits Investment Society. I'm an honor student part-time doing economics. And I have my co-host here, Lufuno. I'm sure she can also introduce herself.
Yes. Thank you, Simon. Thank you, Tabang. I am Lufuno. I am currently an undergrad student studying my third year in finance, management, and HR. So that's about it. So today, as Tabang indicated, we're going to just be going through all that is to do with Accelerate Property Fund, including their property portfolio, where we dive into their properties, including the one based in Fourways. So Tabang, you can just walk us through into those questions and
All right. So Accelerate Property Fund is a topic of discussion. There's been a lot of back and forth regarding the performance of it. And I just thought that Simon Brown is the perfect guest to sort of clear the air and sort of give us an understanding of what's happening with the Accelerate Property Fund. But before we get into it, just for our listeners to be on the same page, I think we should start off by explaining what exactly is Accelerate Property Fund. Simon,
Yeah, so I can jump in here. I mean, the company itself is, I'm trying to run the math. I mean, it probably was founded by the founding family back in about the 70s. In 2005, they took a disparate number of different assets, put it into a single entity, and then listed as Accelerate in 2013. The reason they came to market in 2013, aside from the general reason you come to market, you can raise capital, it raises your profile and the like. But what it also does is they list particularly in the REIT space, Real Estate Investment Trust. If we go back 20 years ago on our JSE, we had property loan stocks and property unit trusts, and they were how we did property in South Africa, but they weren't tax efficient in the way that REIT is. And what had happened was the rest of the world, most notably Europe, North America, Asia, Australasia, had started moving towards the REIT structure. The key benefit of the REIT structure is that the taxation doesn't happen within the fund itself. They pay distributions. They need to pay 75% of distributable income to the shareholders, and we then pay tax on that. So when I get money from Accelerate or any other REIT, I don't pay tax on the way through, but it arrives in my account as income. So it gets taxed as income tax accordingly. And that, of course, is, Accelerate or the REIT, whatever it might be, it's had revenue come in, costs go out, and that distributable earnings. And that's a huge advantage. And we've seen all of the PLS and puts, property loan stocks, property unit trusts on the JSE convert into REITs. Most of that happening well over a decade ago. A quick little asterisk to that. When we hit the pandemic, things got a little bit wobbly, and we can dig into that, particularly around Accelerate. But that certainly meant that some companies just weren't paying their 75% distributable income. And in some senses, I didn't know what was going to happen. Would they be delisted? Would they be stripped of their REIT status? In essence, the JSE kind of let it slide. I think, frankly, on the view that, this is a pandemic, these things don't happen often, touch wood. Let's kind of let it slide for a couple of years and then sort of come back again. And it worked. I mean, most property stocks or REITs are It's now trading at fairly significant discount to their net asset value. They're trading at fairly attractive distribution yields, whereas property itself as a sector had actually peaked back in 2017, early 2018. The sector had just got too expensive. The loans were too big. So property actually peaked a couple of years ahead of the pandemic, and in most cases is still not yet back to those pre-pandemic levels.
Wow, a lot has happened. And just before we get into Fourways Mall, can we probably highlight some of the key milestones or significant developments that Accelerate Property Fund has achieved over the years?
Yeah, I mean, for them, really, it was the listing in 2013 was a big one for them. They've got a really good portfolio. They talk around a nodal investment approach, and we can touch on that in a bit, which kind of separates them from other REITs. And that's an important point. In South Africa, we've got a fair bunch of listed REITs, but they're all kind of in the same sort of niches, which is you're either in retail, either in industrial, or you're in office. Some of them overlap, but then they try and distinguish themselves. There's a little bit of residential. Octodec, for example, does residential in Pretoria and Johannesburg. Spear's speciality is Cape Town. Others like Growth Point is a bit of everything. Hyprop is high value malls, sort of your Rosebanks, your Hyde Parks and the like. What we saw with Accelerate was looking at that nodal approach. They had initially also had some offshore properties, and that had been part of their sort of their strategy as well. They no longer have those offshore properties. They're now focused in three areas. That is sort of it's Fourways, a little bit in George, the Cape Town foreshore down at the harbour. And the Charles Crescent as well. But broadly, it's Fourways and it's the foreshore. They no longer have those offshore assets any longer. They have disposed of those. They focus on shopping centers. They focus on urban shopping centers as a rule. And the distinction there is you've got companies like Fikile, for example, and to a degree Fortress, who focus on the sort of more sort of township / rural type shopping center, where you go to an area. And I'm thinking in Mpumalanga, but in Mpumalanga down in KZN, just off the N3, where you put a shopping center in there, and suddenly you've got a community who used to travel to maybe Hammersdale, maybe Pietermaritzburg, Camperdown, Hillcrest, maybe even Durban for a shopping center. Now they've got one right in their community. So it immediately has a huge amount of foot traffic. Whereas if we look at the other malls, let's take, for example, Rosebank. I mean, there's Rosebank Mall, there's Rosebank Zone, they're the Firs. They are literally right next to each other. So it's a different sort of strategy in that regard. And Accelerate really is focusing on, and there's Fourways, there's the Cedar Mall, the sort of two big ones up here in Gauteng. And that's really been their strategy to go for those sort of higher end malls.
You mentioned the various competitors, right? Other property funds. How does Accelerate compare to its competitors?
So, in terms of I mean, there are a couple of ways to measure it. The one is just in terms of the assets that they have. And they have, I think, good assets. Absolutely, they do. I mean, let's be clear. It is tough at the moment. I mean, it being anywhere in the REIT space. Consumers are under pressure. High interest rates, challenges with Eskom. We know all of those sort of stories. The challenge they've got is in the mall space. And we'll talk around Fourways in a bit. The challenge there is that foot traffic obviously completely collapsed during the pandemic. It has come back, but it's come back with challenges. Now, make no mistake, office is by a long way the space you do not want to be in. Logistics is absolutely booming. Retail is still there, but it's becoming so much more competitive. I mean, think about wherever you're sitting right now and you want to go to a mall. Unless you are in a rural area, your choice of malls is absolutely significant. You've got huge choice. I'm here in Rosebank. I've literally got 3 malls that are, I mean, they're 50 yards away. I'm right in the heart of Rosebank. but I could hop in a car or a Gautrain or catch a bus. I could go to Hyde Park. I could go to Killarney. I could go to Sandton. And I'm still, within minutes away from where I am at this point in time. So their differentiator was the higher end mall, and that has proved challenging post the pandemic.
Oh. And right, just to add on to that, so accelerated property funds market capitalization has decreased from 1.2 billion to 885 million, right? So I know they've appointed new CEOs. Excuse me if I get their names wrong. It's Darwin.
I'm leaving that to you, Tabang.
All right, let's just say they appointed two new CEOs. So there's a new sort of strategy and management that is put in place to sort of restore investor confidence and attract new investors, right? So, what would be the main reason for the decrease in market capitalization?
So, and let's step back a moment. And market capitalization is ultimately what the value of that business is on the JSE. And that the market determines. That's you, I, and others who are buying and selling the shares. If there's demand, the price rises. If there's supply, the price comes down. What we also have underpinning is a net asset value. In other words, what are the value of the buildings that they physically have? And what we typically would expect is a REIT to trade at a slight discount to the net asset value. What we've seen in the case here is a significant discount to net asset value. And there are concerns around occupancies. There are concerns around average weighted lease, which they call weighted average lease expiry, rather, which is what they call WALE. That's down at 3.6 years for the 2023 financial year. That's short. That is absolutely short. The concerns around the loan to value, in other words, what is their debt relative to the value of the buildings that they have? That went to 47.7% in 23, up from 42.1% in 2022. That is a high number. Traditionally, pre-2017, you were seeing numbers in the low to mid 40s. But now the market is saying, hang on, we actually want numbers in the low to mid to maybe high 30%. There's also the question of loan to value is what's the value of the building. Now, a building value is I don't want to say it's subjective, but certainly it's dynamic. If you'd had a building in December 2019, an office park, for example, in December 2020, its value was fundamentally different. So in a sense, the value is replacement cost, but it's not. The value is what can you extract from it? What is the ability to generate revenue from that building? And that's what we typically call the cap rate is if I've got a building making me, and let's use some simple numbers, it makes me R1 million revenue per year. Then at 5 million value, it's a really good deal. At 20 million value, it's a significantly less good deal. So that fluctuates as well. What these REITs would do is they would typically revalue on a 3-year rolling period. So they will be continually revaluing. Their vacancies was up at around 17.7%. So, and we'll talk about these in a bit. There are some easy wins that they can start to do. A big part of it is that loan to value, which is the harder part, which is hence the rights issue for 200 million, rather than going back to their bankers. Now, maybe they went to their bankers and the bankers said no, but they needed to raise fresh capital from the market to put into that Fourways Mall.
Right. So on to Fourways Mall. I think now we can sort of jump on to the main topic of discussion. So just to go back a bit. So Fourways Mall was renovated at the beginning of COVID. And ever since the beginning of COVID, well, ever since the renovations were done, they have really not seen much traffic coming into the mall, right? There have been vacancies. Fourways Mall has not been full to capacity. And at the moment, the vacancies are currently increasing, right? And it has been on the headlines lately, Fourways Mall. And just to add also that the value of the mall has actually reduced from 4.8 billion to 4 billion on the dot, indicating that there are challenges, right? So what would you say are the primary factors contributing to the decline? And how is Accelerate Property Fund addressing this?
That's a great point, because this is really is at the crux of it. Accelerate owns many properties. Fourways Mall is their flagship asset. Let's first look broadly at the industry, which is, truthfully, I think our mall situation in South Africa, I think we are overtraded. But what happened during the pandemic is we all discovered online shopping. Yeah, we'd been doing a bit of online shopping, but we started doing a lot more online shopping. We're seeing strong competition. For example, Bash, which is the Fashini Group, which is all of their brands together. Mr. Price is big in the online space and owns Yuppie Chef these days. Of course, Take a Lot. We've got Amazon.co.za that arrived earlier this year. We've got Temu. We've got Shine. There's suddenly a lot happening in the online. Now, during the pandemic, almost everything went online. We all discovered Checkers 60/60. Post-pandemic, we started venturing out again, but our shopping habits had changed to a degree. I use an example. I had never in my life bought clothes online, but during the pandemic, I needed shoes, I needed jeans. I bought them online. And it was an experience which I was worried about. I didn't know how it was going to work, but it worked well. And let's be true, I've gone back to buying clothing in store, but in the back of my mind, there's that online component there. I was very much shopping Checkers 60/60. The problem with Checkers 60/60 as an example is that I do it. Checkers ShopRite gets the sales. They're quite happy. The driver gets his commission and a tip, and everyone's happy. But the mall is not happy because I haven't done the foot traffic. What they want me to go is to the mall, to go to Checkers, to go and buy my weekly, monthly groceries, and then whilst walking around, maybe go have a lunch or a sandwich or a cool drink, or pop in somewhere and do some browsing and maybe buy something from one of the other stalls in the mall. So it becomes getting foot traffic back into the malls. The challenge they have now is that all of the sort of premier malls are having this challenge. We saw the Hyperop update a day or two ago, and they talk around foot traffic is picking up, but it was around 7% increase in foot traffic, but sales were only up some 2%. In other words, we are window shopping more. And that's because we are poor. High interest rates, high inflation. It's also because of petrol price. It's expensive to go to a mall. We've got to get there. We've got to drive there. Once we're there, we've got to pay for parking. So what we're seeing is malls are trying to reposition themselves more as destinations, more as entertainment. Some, for example, you will see Hyde Park and Sandton have done it. They have their area of hyper luxury, the sort of stuff I can't even afford to walk past because it'll sense my wallet and the lack of money in it. And, you're just scared. You look in a window and they're going to invoice you for something. So the malls are having to really reposition themselves and make themselves that destination, and that's the hard part. And what they're doing at Fourways, for example, they're bringing in a McDonald's, and that's a great idea because McDonald's is a huge brand in the QSR space, quick service restauranting. It's hugely popular. It is, again, there are a lot of McDonald's around, but it does draw people in. They're bringing in a Sequoia. They've got a John Dory's that's coming as well. A Volvo and Cherry. They also got a Police that's coming in. A Hatchet London. I have to be honest, I don't know what a Hatchet London is. But it's now that store mix is becoming so incredibly important, and that actually cuts both ways for Accelerate and in particular Fourways. With a vacancy of 17.7% across the group, it gives them flexibility. Now, the problem with vacancies, you go to a mall and they're dead areas of the mall. And then people don't go that area, and the few shops that were there don't get foot traffic, and it becomes self-fulfilling, right? It gets worse and worse and worse. You've got to sort of almost cut back into the mall, get back to the basics and start expanding out again and get that foot traffic coming back. You've got to get anchor tenants. You've got to have some big grocers, a Woolies or a Checkers, maybe a Pick and Pay, maybe a Spar. In the olden days, a cinema, a new metro, or a Steak-Inico was a big deal. That's no longer so important. A Dis-Chem or a Clicks is critically important. If you've got the grocery retailers, they'll probably also bring a liquor store as well, a Checkers or whatever brand particular in that space. You've got to start getting the feet back into the mall, and that's so important. Some of them do it with sort of non-mall activity. Rosebank's got the rooftop market every Sunday. That's been going for as long as I've lived in Joburg. That brings traffic. You know, you're not going to the mall, you're going to the roof to go and eat or buy whatever it might be the case of, but you're going through the mall, you're parking in the mall. So we're seeing a lot of trying to turn the mall into an experience. So it's less about, I'm going there, I'm doing my groceries, I might look at one or two shops and I exit. This has become, well, can I get a family or a couple or friends to come into the mall as an experience for a couple of hours? And this is a global trend, and it's difficult to do. It is difficult to do. We're also seeing redesign in malls, a lot more open spaces, a lot more sort of benches which you can sit at. Small things like an ability to charge a mobile device, you charge your phone, free internet, in some cases, free parking, or at least cheap parking, a lot more airiness, a lot more natural light into the mall. So it's becoming a lot more, it's not just what stores have you got, what's that bigger experience that you've got at the same time as well. And then it's small things like how convenient your parking. I think of Kalani, which I haven't been to in a very long time. It's owned by Octodec and it has its own challenges. But the parking just always, to me, was like, it was complicated and difficult. And, whereas Rosebank and Sandton and Hyde Park, I know where I go. I know exactly where I park. I know where I am when I park. So it's small things like that too.
So what I'm getting from this is that Fourways Mall has to offer more than just a shopping destination, but has to offer an experience, right? When you look at Mandela Square, right? I think also what makes it succeed is that it has a lot of exclusive stores, right? Especially when you go to Diamond Walk, there's the Louis Vuitton, there's the Gucci. Those are stores that you don't find anywhere, right? So I think that also sort of increases traffic. And then when you look at fine dining, Mandela Square also has, a large variety of restaurants, right? So it's also that experience. And I feel as a Fourways Mall, when it comes to, the exclusive stores and the fine dining, it's not really, doing well as compared to its competitors. There are a lot more better options, right? And as you mentioned earlier, saturation. We've got Monte Casino by Fourways Mall. We've got Cedar. We've got so many shopping centers around, right? Yeah. And people want convenience. No one wants to park on the 5th floor and pay parking. And, I could just drive to Fourways Crossing, free parking, go to Pick and Pay, and I'm out. So that's the convenience that people are looking for, right?
You're 100% right. Sorry, yeah.
Oh, sorry, Simon. I just wanted to add to that regarding what Thabang just indicated, because I think the most important thing, especially when it comes to competition, is to dive into how other competitors are doing, where like what he said with Sandton, with luxury stores. I feel like it's very important that we not only look into one specific part it's true that people, like the purchasing power is declining, also looking into the economy. But it's very important that we also take into account where there are business people that go to like your Monte Casino, where there's like hotels and restaurants there. And they also would like to go to like your Louis Vuitton, your Gucci, just to, spend like some few cash, here and there. So I feel like it's very important. And obviously just wanted to check into that, like, the strategic objective, like going into such things in terms of not just having a viewpoint on, let's say, one specific target market, but like going through like other people like who are willing to actually spend, a lot. And that in its sense can lead to the foot traffic increasing. So, yeah.
Yeah, 100% correct. And let's use Mandela Square as a quick example, which is more adjunct to Sandton Square. It's also got the Mandela name. It's also got that giant Mandela statue. It's It's also got hotels around it, and it's a business district. So what we see is business people flying to Johannesburg. They catch the Gautrain, bang, there they are. They're at Mandela Square. They can stay at a fancy hotel. They can stay at a slightly less fancy hotel in their evening or their day off or something. They're going to wander around that space. They're going to eat there. They're going to shop there. We have people from the rest of the continent who come into Johannesburg to go and do their luxury shopping in that diamond walk at the Gucci's and the like, because they don't have it in Kinshasa or wherever the case may be. So it's things, and we see similar-ish in Rosebank. We don't have the same level of brands, although we do have some high-end. We do have some fine dining. We also have hotels around. We've also got a Gautrain station, which fundamentally shift things. Now, public transport or at the level of Gautrain, not much more can do about. There is a lot that, one of the things with malls when Uber started coming on the scene, it was, they would drop you off outside a mall, but there was no walking access to the mall because everyone used to come in their car. And yes, there was some taxi access, but that was kind of restricted and the Ubers weren't going through there. So it was shifting with the times and making accessibility, and I noticed, and again, let's use Hyde Park, the Uber would literally drop you in the street and you'd have to walk through the boom gates and everything. What they've now done is they give you 15-minute free parking. So the Uber goes in and can drop you at a e-hailing space. So you're now in the mall. It's not that horrible experience of sort of, frankly, walking through with the traffic and trying to get in, which raises a whole bigger issue around, how were the people who were working at Hyde Park accessing the mall? Because they were being dropped off via a taxi out in the street, and the mall kind of hadn't thought through that either. To your point around brands and around fine dining, there is the consumer's under pressure, but we still have disposable income. There is disposable income out there. We can see it. We have foreigners, whether they be from the rest of the continent or more broadly. Certainly, there is spending happening. A lot of the contraction is happening in the lower LSM because your two biggest expenses as a lower LSM is typically food and transport. And those have been the two big inflation numbers over the last 2, 3, 4 years. So, if more than half of your salary is going on those 2 points, and they were running at one point around 15% inflation, your paycheck has been decimated. The middle class is absolutely struggling. So is the higher LSMs, but to a lesser degree, they've got better access to credit. The problem with the fine dining, Tabang, let's say, Lufuno, Tabang and ourselves, the three of us, we have ourselves a lovely fine dining establishment, best steaks in Josie, a lovely wine list and all of that sort of thing. Firstly, we want to go where there are already customers who've got the wallet to spend it. But let's say Fourways then comes to us and says, would we open a branch in Fourways? For us, it's a huge expense. A restaurant like that is 20, 30 million rand to kit out. And then we need to be sure that we're going to get the foot traffic. So we're going to say to Fourways Mall, okay, but it's going to cost us 20 million. How about you pay half? And now it's suddenly like, so it's that sort of conversation and we're seeing that a lot in the office space. You'll see the signages, less so these days, but you drive down Peter Place, you in Bryanston and other areas, 125% of your first year's rental back on refurbishment. Because so basically you sign a 5 or 10 year lease and they will help you refurbish at their cost because they so need to entice people. But you then need the cash flow. Fourways needs that cash flow and that foot traffic. And now you've got that chicken and egg, which is why I think something like a McDonald's is quite a clever thing, a John Dory. It's not the high-end fine dining, but it is the family experience. A Spur is a great example. Spurs is the classic family restaurant. I hardly ever go to Spur because I don't have kids. But if I had kids, much of my friends who do have kids, they're at Spur all the time. So it's getting that traffic in. And hence they did the rights issue, the 200 million. And at the time they said, this is for Fourways Mall. We're going to use it to reposition it, to upgrade, for want of a better word, and to get that foot traffic back in. And once we start getting the foot traffic back in, we then get the vacancies under control. We've then got better pricing power on the lease renewals, and all of that sort of starts to play together.
Just on that, so one of the new CEOs had mentioned that they're going to put a Planet Fitness, a gym, into the mall, and a gym will basically also sort of increase foot traffic because people go to gym every day, and then they're going to create sort of like a sports section where people can gym and also access the relevant stores, right? So you mentioned the 200 million, right? So is throwing money at the problem the solution? I mean, earlier they had mentioned that the CEO has asked the shareholders that, look, we need to raise 200 million to address the challenges that are faced by Fourways Mall, right? So is it efficient enough to throw money at it, or does it require more thinking and more of a strategic planning? As we mentioned, the stores, maybe we need to relook the stores. Maybe we need to relook certain things, So is money really going to fix? Is 200 million even enough to address the problem?
Thank you. With that also, Tabang, I just also wanted to add, because looking at the gym also, I feel like, again, where with the 200 million and like money, where it's placed, I feel like it's very important to also consider, because looking at gym, I feel like in as much as there could be like that input to say that it could increase foot traffic, but you find like various malls that are also still having issues with like foot traffic regarding gyms because it's also expensive in itself. And again, with that, we have, for example, the airplane, which is something that I also did want to get into, where the space, the utilization of space within the mall itself, where what is the whole strategic intent regarding that also, because I feel like there's more that can still be done around the mall. There are certain stores that can also be overlooked where, in essence, where if, let's say, there's not enough sales coming in, how about we look at maybe like, revamping it and like, I don't know, placing new things within the mall in areas where we're not actually seeing any profitability coming in or whatsoever. So yeah.
Yeah, Lufino, you make perfect points, and I like your point around Planet Fitness, because a Planet Fitness is, yes, people go to gym. Do once a day. I don't know what you are. I don't do my gym once a day. I aspire to it, Tabang, but I hear what you're saying. But again, it's a nice foot draw. Is the market there right for it? And I don't know. I mean, these are the sort of things which the management need to, and it's not just a, let's say you get Planet Fitness. You're going to go and do your research. You're going to see, well, okay, what other gyms are there? How busy are they? Would we be more convenient? Would we be a longer or a shorter drive? If my gym drive is currently 12 minutes and I can go to the Fourways one and now it's only 6 minutes, well, that's not a bad idea. And that brings me some foot traffic. But again, pricing, what are my competitors? Is there an independent gym which is very cheap and we can't really compete with it? So it's always those different dynamics. Is 200 million enough? I don't know. I mean, I honestly don't know. Management obviously thinks so. They managed to raise the money, although I'm checking, the cents came out 2 weeks ago. So they got the 200 million in total. Did they get the full amount? Yep, they did for underwriting portion, but only 54 million of it was actually taken by the underwriters. So shareholders ultimately only took 145 million, but they've got their 200 million. I imagine they must have done their numbers. They wouldn't have gone. The last thing, doing a rights issue is a juggling act. You want to take as little as possible, but not too little, if that makes sense. You don't want to ask for 200 when actually you needed 300. You also don't want to ask for 200 when you actually only needed 100. So finding that sweet spot of what you really need, but they're the experts here, right? They're property managers. So let's assume that was the right number. The flip side is, what will the market bear? Maybe you needed 500 million, 500 million. but you simply couldn't, you didn't think the market would take it. So you had to go for a smaller amount. From my understanding is that they ran the numbers and they said, look, 200 million works for us. And that then enables us to do a proper refit of the mall, a proper, spending on it. And, in some sense, 200 million is a giant amount of money. The flip side, for a mall that is worth, billions of rands, it's fairly small. So my sense what management seems to be saying is that there's some things that we physically need to do that's going to cost us some money. But there are also some things that we need to do that's not necessarily a cost. It's a strategic positioning, a McDonald's, a Planet Fitness, a John Dory, those sort of things, which and maybe they go to Planet Fitness, John Dory, McDonald's, and give them some of that 200 million for the fit out. I don't know what the terms and conditions are, but it's not. And let's go back to Killarney Mall. Killarney Mall has structural problems. When it rains, the mall leaks. That's a problem. So they've got to spend money on actually just waterproofing it, which is not lacquer, because you spend all the money and now all you've got is a place that doesn't leak, and everyone's like, well, duh, of course, that's what you want, is a place that doesn't leak. The Fourways Mall doesn't have those sort of structural issues. So where they spend the money, there will be to the people in the mall, both tenants and shoppers, immediate improvement, and they'll immediately say, hey, look at this. Just a quick side note on that is that depending what the work is, when you're working on a mall in terms of fixing, expanding, whatever the case is, it can be messy and you can lose shoppers during that period as well. And then you have to do a significant relaunch and get it back into the community's sort of thought process, line of sight, and get that sort of reattract that foot traffic again.
Investec now owns 8% of Accelerated Property Fund. This is because of the loan default that one of the executives had defaulted on his loan. So now Investec had forcefully taken 8% of Accelerated Property Fund. So how is that sort of going to change the shareholder dynamics and also the strategic making sort of processes? I know banks generally are not involved in the management of businesses. They just want their money, right? So how is this going to sort of affect the shareholder dynamics and the strategic decision making?
Yeah, so it's a great point, and I mean, 8% doesn't give Investec that much, right? It might give them a seat in the board, but the flip side of the coin is that Investec's got 8%. To your point, Tabang, they want their money. They don't want to be property owners, so they might take more of a hands-on, because Investec has a property fund of their own. They've got a lot of experts in the building in Grayston, in Sandton, who can perhaps assist accelerate a property fund. So there might be a closer working relationship between the company and Investec. And Nedbank's also got a 5.5% stake there. So certainly they don't have control, but certainly they could bring expertise. The flip side of the coin is that Investec might look at this was security for a loan. They look at it and they say, truthfully, we want to sell this 8%. So it means that you've actually got sellers there, which is a potential problem for a company, for any company, when there's someone who wants to sell 8%. Now, there's not enough liquidity in the market for them to sell via the market. They're going to have to find a buyer or buyers to take it essentially in a block, maybe 2% or 5%, or maybe all 8% of it of the like. So directly to Accelerated Property Fund, in one sense, it doesn't necessarily mean anything. It's just a shareholder, but it could bring some expertise. And it does mean that there's a shareholder who potentially wants to be a seller at some point. So it's not really the worst thing for them. There's potential upside for it. I mean, the only really bad part is that the Investec might want to sell their 8%, and that creates what we call a share overhang. But Investec might also bring some expertise. But typically, if I own a business, I do own some businesses, and I know my shareholders because they're small little businesses and the stuff. But when you're a listed company, most often you don't know who your shareholders are, and you don't really engage them. Now, an 8% shareholder, when they rock up at the AGM, have certainly got a little bit of voting power, but 8% is not enough to block, not even special resolutions. Special resolution needs 75%. So, they're not big enough to really make life difficult for management.
Oh, we just hope for the best. So what are the expectations regarding the financial performance and the valuation once the revitalization has been done? So once the renovations and the refurbishment and the shape shifting of the mall, what are the expectations? I mean, what are your expectations?
So I think there's a couple of things we're looking for. I mean, this is their year end will be March, end of March. So we will be expecting results from them fairly soon for the full financial year. The last set of results was 6 months to end September. It's not going to be very different from the picture because the rights issues happen post-period end. But again, it'll talk more around strategy, around planning. Maybe they've had some easy wins at the mall, the Fourways Mall, which they can talk around as well. It's really the current financial year. There'll be some numbers to September, but then the 25 financial year, which will be numbers to end of March of next year. Correct. What we're looking for is, I think, probably 4 key numbers. Loan to value, how's that doing? Coming down significantly a little bit. Occupancies, how's that doing? What's the occupancies looking like? Is that moving in the right direction? Rent reversions. They made the point that the mall is 5 years old. They had a lot of 5-year leases. They have to re-sign those leases. What prices are they getting? Are they getting higher prices than previous, lower prices than previous, same prices than what they've particularly seen? So those are the sort of 3 key metrics. And then the fourth one is going to just be around good old-fashioned foot traffic. Are we seeing people coming to the mall? Are we seeing sort of things happening again? So at this point, the perspective is we don't have a lot to go on. They raised their 200 million. We know what the story is around that. It's going to take some time for that to start reflecting in the numbers. They might do some, they've got to publish results, of course, but they might do some announcements. When they publish their results, it'll be to March, but they might give us some indication of what's been happening in April, May, June. In other words, the months subsequent to March. So we might also get some sense around that as well to start to give some glimmer. In the one sense, the key point, and it's what you alluded to, and I need to quickly pull up the number here so that I'm sure that I'm giving the right numbers, is that the net asset value per share is, call it, so this is 4.13. That's out of date. That was March last year, but let's call it that. And the share's trading at 49 cents. So essentially, you can buy a 4 rand asset for 50 cents, which on the surface is an absolute bargain, unless it's going bankrupt. So the other thing you want to see is what are their stress tests? How are their loans? Are bankers chomping at the bit to get the money back? Are bankers calling in loans? What is their loan profile? In other words, what is the duration? Have they got a lot of loans expiring in the next 12 months, or a lot of these loans in 5 years' time? What type of loans? Are they floating rates? Because if they're floating rates, when we start to see the Reserve Bank cut rates, they'll take a little pressure off their interest payments. Or are they fixed? But at this point, the market is almost saying, we don't think this business survives. And certainly, there is risk. There's always risk. There certainly is risk here. But if it does survive, you're buying a 4 rand asset for 50 cents.
And just to sort of look at the future outlook of Accelerate, there's been speculation that there's a potential takeover or delisting of Accelerate. How do you assess the feasibility and the implications of such a scenario? And what is the actual fund doing to sort of address this to their stakeholders and to their shareholders?
Yeah. So, I mean, a takeover, again, I'm buying a 4 rand asset for 50 cents. And we're using round numbers there. Don't anyone necessarily quote me on that. But, it's at 50 cents. I could make an offer of 1 rand a share, which is double the current share price. And I'm buying a 4 rand asset for a rand a share. That's still an absolutely great deal. But the shareholders aren't going to approve that. And that's the problem with the buyout, is that the shareholders are just going to say, thanks, but we don't want it. If I pull up the quick shareholders, we've got the Michael family, because I'm not even going to attempt that surname, Tabang, holding 29%. We've got iGroup Holdings holding 31.07. So that's 60% of the business. And they're going to say, no way am I selling this asset so far below its value. So I think an option for a takeout is very unlikely. I think that is very unlikely. Just to go off track, for example, Invicta, which is a brilliant little business. Its net asset value is about 50 odd rand. It's trading at about half of that. It's tough at the moment. That they basically do industrial and manufacturing machinery. But if I went and offered 40 rand, the biggest shareholder, Christo Wiese, is just going to say, no way I'm selling a 50 odd rand asset for 40 rand. He wants to sell it at a premium. So I think at this point, a delisting via a takeover is unlikely, unless there's an exception here. The majority shareholders, the 2 shareholders who hold 60%, unless they do the delisting. They go to the remaining 40% of shareholders, they offer them a nice premium. Let's say they offer them a rand per share, and they say, you currently got 50 cents, I'll pay you a rand, and they buy the 4 rand asset at 1 rand a share rather than 4 rand a share. So that is, I think, the only possible. And I don't know, I have no insight. It depends on liquidity. Can they afford it? It's going to cost them about 500 million rand, maybe. I don't know if they have 500 million or if bankers will lend it to them. But the short answer is, as is often the case in business, and often even more times perhaps in property, they've got good assets. I mean, the assets might be not functioning as well as one could hope. The assets might not be at their absolute peak, but Fourways Mall it's a good mall. It's a good location. They've got other assets as well. We've focused on Fourways Mall because that's their key asset. They've got others too. They're not going to. Those assets aren't going to disappear. And I think, to the last point, is there a chance of bankruptcy? There always is. Business rescue. I think it's probably, I would assign it a low probability, simply because the assets are there. And to your earlier point around bankers, the folks who have the loans are unlikely to call them in, because then they're part of a business rescue process, and no one wants that.
All right, so I think we'll wrap it up at that. Thank you. I don't know, do you guys have any other questions, Lufuno?
Oh, no. I just wanted to say, but obviously, I think it's obviously a sad thing regarding like the shareholders and the intake, in that they wouldn't accept anything lower than that. But like, I feel like in such situations, I mean, it's very much, it's likely for them to actually have like a capital loss, especially when it comes to their shares, because looking at the value now and where it stands, I mean, also in terms of bidding, who would want to also buy at a high price, concerning what it's looking like right now? And in as much as you may be saying that Accelerate is looking towards turnaround strategies, which could ultimately increase the value of the company itself, but there's again risk tolerances, especially when it comes to investments, and it's very critical where you actually put your money in, and I think that's what they're trying to gather from all of this, that in as much as, yes, I could potentially help a shareholder, but also I don't want to put so much money into something that I don't even know if there's actually going to be like a potential upscale in the future. So yeah.
But Fino, you're 100% correct. Yeah. There's, we've been talking bricks and hamburgers and debt and all of that practical stuff. There's an emotional aspect to trading. Someone paid 6.50 Rand for this share 7-8 years ago. If they still hold it, they're not happy about it. Inversely, the 12-month low was March at 39 cents. Someone bought it 39 cents, and now it's 49 cents, and they're an absolute rock star. So there is companies, when you value them, there's accounting, there's businesses, in this case, there's buildings, but then there's the emotional and the psychology on top. And that's which is more important? Well, truthfully, they're both important. If I was a R6.50 buyer 7 years ago, and you offered me R1, am I going to say, well, it's better than 50 cents? Or am I going to say, hang on, I paid R6.50 versus the person who paid 40 cents, you offer them R1, they're like, yo, 150%, I'm taking it in a minute.
Yeah.
And that's what gives me a job in markets, right? And that's why I can do radio shows every day, because it's that dynamic of emotion, fear, greed, FOMO, YOLO, and all the rest.
No, 100. But thank you, Simon. Thank you so much for that.
No, Lufuno, Tabang, my pleasure.
Now, that was from myself and my colleague Tabang. And as we draw near to the end of the show, we'd like to extend our heartfelt thanks to our audience for tuning in, and also to our esteemed panel of financial journalists for sharing some valuable insight. Remember, the world of finance is ever evolving, and staying informed is key. Keep exploring, keep learning, and until next time, stay financially savvy. This is Finance Unplugged. Signing off.